So welcome. I'm John Vance, president of Vance Wealth. Today, we're going to be covering a very exciting topic, tax planning 101. I know you just got your taxes done. The tax deadline was yesterday, which was April 18th. And so maybe this is the last thing you want to do, but we do have pretty good attendance. So maybe this topic is still timely. I know tax bills in general went up this year because of the strong market gains that we've had over the last couple of years. So we wanted to do this in April to kind of get everyone thinking about, tax planning for 2022 and really how to set yourself up for success. There are things we can do to help mitigate some tax liability. So I guess don't shoot the messenger. There's a lot of stuff in here. When you start getting into taxes, it's pretty technical, obviously, because we're dealing with the code. I'm going to try to kind of frame it in a way that's digestible and actionable. There will be some topics where you're like, hey, this doesn't apply to me. We'll have, we're going to go through a series of slides. But I do think that this is a really good topic, and we'll be posting this up on YouTube after. So feel free to share this because it's a great topic. I know I tend to talk fast as I'm going through this, so just bear with me. I do think there's a feature on YouTube where you can slow me down. I think you can do like less than 1 times. You can actually go slower if you need to. So if you need to watch this again, but and just as a reminder, while this is being a webinar, we don't do like a live Q&A where you can ask questions. What we do have in the basically in the comment section, or the Q&A section, excuse me, you can type in some notes there. So I'll probably periodically be checking that to see if it pops up. And then so you can ask some questions. The one big thing too, taxes are very unique, they're very specific. So most of the stuff we're going to cover today is just a reminder of some of the really good, thoughtful planning you can do. But additionally, these are great questions for us as your advisor who help you with some of the ongoing tax planning. But it's also there to, maybe empower you to talk to your accountant or your tax professional based on, some of these ideas. So this presentation will also be available if you would like the slideshow. So let me just see here, make sure I get this advanced. Okay, so here's our disclosure pages, which I'm not going to read through. All right, so first thing, let's just start high level. So we obviously pay taxes for a reason. Now, this is just, we're going to deal with a lot of things primarily around federal income taxes. So we're going to, I wanted to pull this chart up because it's always fascinating to kind of see, well, what is our budget? What do we spend money on? This should not be designed as a political conversation because it's not that at all. Just wanted to kind of show you what the federal finances look like. So a bunch of charts on this slide here. On the far left-hand side, it's dealing with the 2022 federal budget. And the first column, which shows all the spending that is earmarked for this year. And then the column to the right of it is showing the sources of financing. Basically, where is the money coming from? So you can see as you start looking at our budget, we have this big other category that's $1 trillion. A lot of stuff gets put in there. We have net interest expense. So that's the expense on our deficit that we're running, non-defense discretionary spending, defense spending, Social Security expenses, and then Medicare and Medicaid, right? So you can see kind of the big buckets. And then on the right-hand side, you can see the sources of that financing, income taxes being the largest at the bottom, followed by corporate taxes, then the social insurance, which essentially is the Social Security tax that you pay, the FICA, and then you can see borrowing. So obviously we know that this has been a big challenge for our country, for our government, as we're borrowing a lot of money to finance our operations. So you can see here that shows you the projected borrowing number. Some of the other items just kind of look on the right-hand side. It shows the federal budget surplus / deficit. If you notice on that chart, everything positive means we have a deficit. Anything below the line means that we have a surplus. And so we had a brief surplus back in 2000. And you can see we've been running some big deficits last 2 years, understandably, right? Because COVID was a big driver of that. You can see that we're projecting that the deficit's going to get back to some normalcy, not only this year, but in future years. And then the bottom right-hand side basically shows the federal net debt, which basically shows cumulative debts and relative to the size of our economy. So as a percentage of GDP, and you can see where right now we're almost at about 100%, and that's kind of expected to level off. So That's something that a lot of economists will track because once you get too high, meaning servicing your debt becomes too much of a challenge, then that could lead to some long-term challenges for the economy. At 100%, it's pretty elevated. This is definitely something that our politicians are going to need to address. Whether they do or not is a different issue, but maybe I shouldn't say need. They should be addressing, and neither party seems to want to address. They like to continue to spend. So, and that goes, you can see this budget, the deficit's been growing, through all different types of administrations. So that's just a quick update on federal finances. The other side I just want to show real quickly, consumer balance sheet. One of the things we know our government owes a lot of money. It's about $30 trillion. But the consumer balance sheet is pretty healthy. I mean, if you look, basically this looks at our whole country, and on the left-hand side, it shows the asset level between financial assets, pensions, homes. It's about 162 trillion in total assets. And then you can see our liabilities, 18 trillion. So we're still really healthy. We have a lot of net worth from an American perspective, relative assets relative to debt. We're in a real healthy position. And one of the things that people like to look at, and this is something that's really important to understand, is this top right box. It says household debt service ratio. Basically, your debt payments as a percentage of disposable income. And so one of the nice things with rates being low, you can see even the home prices and car prices and things like that are going up relatively, meaning the percentage of the expenses relative to your disposable income is actually near 40-year lows, which is a good sign for the economy. And you can contrast that to that peak on this chart that shows this was the fourth quarter of 2007. We're at 13%. We're now down at 9%. So this just wanted to give you kind of an update on where things are from a consumer. Now we're going to jump right into some of the tax items. So if you are working with our firm, I know we have some clients on this, some prospective clients, some professionals we work with. If you are working with our firm, you know that this is core to our practice as we take this multi-year tax planning focus. How do we look at the tax dynamic, the tax world that we live in, and how do we make good decisions, not only for this year, but trying to forecast out potentially over our lifetime? Now, I'm 47, so going out maybe 40, 50 years is difficult, but the idea is the decisions you make on an annual basis are going to have an impact on tax-related issues. And so we want to be a lot more purposeful around this. I know so many of us are just hardwired to get super excited when we get a tax refund and you get money back, or maybe you don't have to pay. That's a winning moment. For us, that's not really the objective. The objective is, okay, if we can look at this logically over a period of time, what decisions should we make every year to minimize our tax liability over our lifetime? And so that's what we want to look at is, yes, we want to minimize it, but minimizing it for one calendar year doesn't always accomplish that. We want to look at that over multiple years. And that's really where the thoughtful planning that we bring to the table as a firm hopefully adds a lot of value to our relationship with you. And that's really a critical component of what a good financial advisor should do, because this is a big area where if we can do it right, we're saving real dollars. And so a couple things to kind of consider. On the left-hand side, we have higher tax years and lower tax years. So if you're in a year where you're going to have higher income, right? You're going to pay more in taxes. Maybe you want to increase your retirement plan contributions. Maybe you want to accelerate some charitable giving, actually do a little bit more this year. Maybe recognize some losses and take losses in the portfolio if you can. Avoid capital gain recognition. Are there things you can do to avoid paying capital gains, meaning selling assets? Defer retirement account distributions. Maybe not taking that IRA distribution, so we can defer that. So that's if you're in a higher income year or a higher tax year. And then in a lower tax year, there might be things that you want to do: accelerate income recognition, defer charitable giving. Maybe you push the charitable giving into another year. Delay pass-through business expenses, recognize capital gains, and then consider Roth conversions. And I know that's been a big topic of ours, is considering Roth conversions. So this is just a high-level list of a bunch of areas that we can focus on. And so now we're going to drill down into actually not all of these items, but there are several planning items that we're going to be drilling into, and we're going to go a little bit deeper. Okay, so if many of you have seen this, there's a lot of info on here, but it's quite simple. I'm going to focus. This is a tax table comparing 2017 taxes to 2021 taxes. And the reason why we put this together is the 2017 tax rates were changed in the Tax Cuts and Jobs Act. And that was put in place basically effective in 2018. And that's the new tax rates that we have. And so if you look we're going to, again, focus on the right-hand side of this, where it shows this is married filing jointly, and it shows the different tax brackets. So prior to the changes, we had a 10% bracket, 15%, 25, 28, 33, 35, and 39.6. And then the new rates were shifted down to 10, 12, 22, 24, 32, 35, and 37, right? So that was where some of the tax relief came in. So, and they messed around with the brackets in terms of how big the income bands are. But if we look at this, this is basically the rates at which you will pay taxes. So the one thing that's important to understand is that if you make 300,000, 400,000, 500,000, whatever your number is, $1 million, you pay on your first 19,900, 10%, and then you pay 12% on that next bracket. So as you go up this tax table, you pay incrementally more on the additional earned income. It does not tax you back to it does not tax your entire income at one rate. And so that's really important to know. There's this idea of bumping into the next tax bracket. Well, when you bump into the next tax bracket for federal income tax purposes, all that does is it costs you more taxes on that additional income. It doesn't cost you more taxes on all the other income. So just important to know that. The reason why we highlight this is, as it stands today, and we don't know what the future holds, that in 2026, so not that many years out, the way the code or the law was written is that these tax rates will go away and they will sunset back to the previous taxes. So that means that we're looking at a future where potentially tax rates, will go back, and I've highlighted a few here: 25%, 28%, and 33%. So we might go back to these higher rates in 2026. So unless Congress votes, that's the plan. We will go back. So we are kind of making the assumption, a little bit because of the dysfunction we're seeing in Washington, that this is going to happen. We don't know this, but this is what we're planning for. So the reason why I highlighted that 24% tax bracket is we really look at this 24% and the 22% bracket as a kind of a temporary gift, which means if we can pay some taxes at 22 and 24, that might be okay. We might want to accelerate some income because in the future, if we delay the taxes, we're fearful that you might actually have to take money out of your IRA or earn income or sell assets and pay capital gains at some of these higher rates. Now, capital gains are taxed a little differently, and we'll go into that. But that is the concern here, is that we're going to have potentially in the future higher rates, even though we've all been accustomed to kind of thinking that, hey, when I retire, I'll probably be in a lower tax bracket. And under this scenario, that might not be the case. And so that's where a lot of this planning comes in, is if we can be more thoughtful, more purposeful about what decisions do we make today in anticipation of some potentially future higher tax rates, and then how do we make those decisions thoughtfully? And we have to evaluate it every year, right? Because tax situations do change. So that's just kind of a tax philosophy perspective from us. It's probably a little bit different than some tax professionals that are out there, some accountants, but we really think this is a real important core strategy that should be at least reviewed and adhered to if possible. Okay, so that was those are the federal brackets. There's a couple other tax rates that are in place, and they came out of the Affordable Care Act, which is basically otherwise known as Obamacare, right? So that's the healthcare system that we have in place. And they added some additional taxes, and you can see the notes on who that affects. But if you're married filing jointly, your modified adjusted gross income is above $250,000, then you're going to have some of these additional taxes, additional Medicare taxes and additional net investment income taxes. And you can see what they're for. So Medicare is 0.9 on wages, compensation, and self-employment income. And then net investment income tax is 3.8% on interest, dividends, net capital gains, annuities, rents, things like that, right? So anything that's net investment income tax. Retirement distributions, like from IRAs, are not subject to these taxes, either as municipal bond income. So these are additional taxes on top of your rates. So if you're in the 32% marginal tax bracket and you have these types of income, these are additional taxes that you will pay on top of that rate already. A couple of quick reminders as well. Every year the IRS reports standard deductions. So one of the things that we're finding is, I think now it's something like only 6%, maybe it's 7% of US citizens file a return where they itemize their deductions. And on the right-hand side, you can see the itemized deductions are for things like medical expenses, the SALT tax, which is state and local taxes, which is pretty much property tax and income tax to the state of California, mortgage interest deduction, and charitable giving. So that's where the itemized come in. So if you're not itemizing, the standard deduction did go up by a few $100s. You can see married filing jointly, you can see single. And if you're retired, or I should say, if you're over 65, then you can get some of these additional deductions, the married and the single, you see that on there as well. So that's just an important reminder. And so, we know the standard deduction is pretty big, which, wiped out the need for itemized deductions. Some of the things we're going to discuss today, we'll go through some of the ways to enhance some of the itemized deductions and really evaluate are you utilizing the code to the best of your ability and making sure that you make the right decisions. All right, so for those of you on this call that live in California, this is the painful reminder of we live in the highest state tax environment being here in California. So 13.3% is the highest marginal rate. Most Californians live in the kind of sub 200,000 income, 250,000, and then your income tax rates are around 9.3%, and it kind of moves up. So you can see how painful that is. While we have some of our neighbors like Nevada, even Washington, and a little bit farther away, Texas, with no state income tax. So, the reason why I wanted to bring this up is we're having a lot more conversations with people about relocating. So relocating California is part of their retirement strategy. So I wanted to go through some high level things. These are also good items to discuss with your accountant, maybe an attorney, if you're really looking to leave the state and sell your home here, move to a more tax favorable state, just some things to look at. So I actually noticed some people on the call, I think, are planning to relocate. So just some things that you want to do. There's definitely going to be a lot of extra scrutiny when you leave California. California is going to be all over that. They know the tricks. So they want to make sure that have you left the state. So, some of you might think, okay, I will spend 6 months and 1 day in a different state, and I'll still spend some time in California, kind of having dual residence. If you're going to do that, you want to make sure that you follow some of these items, meaning where's your physical presence? Where's your employment, family location, your bank accounts, your driver's license, your social and athletic club membership, residence, business connections. I mean, I've heard scenarios where they'll ask for all of your credit card receipts so that they can actually see where you're actually filling up your car to determine if you were in the state or not. So just be really careful here. This is all a great idea to save some California taxes, but if you're gonna relocate, if you're relocating permanently and you're never coming back, great. But if you're gonna have kind of dual residency and just spend enough time out of California to save the taxes, just be mindful of these things. Make sure you do it right, because you might think you're tricking California or another state. You're not. They're fully aware. And then just a couple, high level things you can see here. Some residency items, states with reduced taxes on capital gains, and then states with reduced taxes on retirement income. So just a couple notes on that. So the reason why this might apply is if you're going to relocate, we're a proponent of reviewing, doing Roth conversions or Roth IRA conversions. And so if we know you're going to go into a lower tax state, we might want to hold off until you get to that lower tax state. So those are definitely some things where we can, factor in some of this good planning. A couple just updates. This chart gets updated every year, and this chart basically shows what are the retirement account contribution limits. So we're going to go through this. We have a traditional IRA and the Roth IRA. The regular contribution, $6,000. Catch-up contribution means if you're over 50, you can add an additional $1,000. And it's if you turn basically 50 this year. So you can do a total of $7,000. That's to the traditional IRA and to the Roth IRA. The 401k, Roth 401k, 403b, the regular contribution is $20,500. And then if you're over 50, you can do, adding the catch-up contribution, you can add an additional $6,500, which gets you up to a total contribution of $27,000. So it doesn't have listed on here, but it's the Roth 401k component. And you have some, there's rules on how much you can, if you want to fund both, what type of restrictions you have. It's basically an aggregate amount, meaning if you want to fund the traditional and the Roth, you aggregate in the two is $7,000, and then the same with the 401k or Roth 401k, your aggregate amount in those is $27,000 if you're over age 50. So just wanted to share that with you. That's usually some helpful information, especially if you're investing on like a regular basis, to make sure that your contribution amounts are keeping pace with the change in the tax code. So there's a lot on here, but this is pretty simple. We get the question all the time is, okay, if I fund an IRA, is it deductible? if am I eligible to fund a Roth IRA? And so this is just a nice, pretty easy visual for if you're married filing jointly and you have the ability to fund a traditional IRAs. If your income is below 109,000, it's fully deductible. And so you can kind of see that up there, but I do want to go through these boxes on the bottom left and the bottom right. So a traditional plan, so tax deductible contributions, right? You do get an IRA, the deduction if you're subject to those limits above. There's no modified adjusted gross limits for a 401k. So when you have a 401k, it doesn't matter how much money you make, you're eligible to fund. And then you get tax deferred growth. We know the benefit of a retirement plan. You have taxable withdrawals, which means when the money comes out, you pay tax. And then it's subject to required minimum distribution. So over your lifetime now, the RMD rules or required minimum distribution rules are at age 72. And then if you have non-spouse beneficiaries, it needs to be liquidated out over 10 years. The Roth plan, which would be Roth 401k, Roth IRA, non-deductible contributions, so you don't get a deduction. Roth IRA has income limitations. Roth 401k does not have income limitations. So it's important to understand the Roth 401k does not have income restrictions. And that's a big misconception, because a lot of times when a new client comes in, they'll say, oh, I'm not eligible for the Roth. And it's like, well, you are eligible for the Roth 401k. So it's something you want to consider, because the benefit of that is you get tax deferred growth, and then the qualified withdrawals, which are most, are withdrawn tax-free, which is really powerful. And it's exempt from RMDs during the owner's lifetime. So that might change, but that's how it's set up right now. One of the big planning topics that we get into often is Roth conversions. So there are no income limitations on doing a Roth conversion. So that's really important to know. We want to distinguish between a Roth contribution, which is when you're adding money, and a Roth conversion, which is when you're converting from a traditional IRA to a Roth IRA, or from an IRA that was a 401k, an IRA rollover, to a Roth IRA. So when you leave it in the traditional IRA, you get to maintain the tax deferred status. When you convert it to the Roth, you're basically accelerating the tax liability, because you're taking that as income now. Okay, so that you're basically taking that tax liability today, but in exchange for tax-free, basically income later, and also you get tax-free deferral. So we like doing Roth conversions when we're in some of like maybe temporarily in a lower bracket. If you went back to that kind of tax philosophy chart that I showed, if you're in the 22% tax bracket or the 24% tax bracket, and we're fearful you're going to be in the higher bracket later, we like doing a Roth conversions. When we have periods of volatility like we're having now, where the markets are, have sold off over 10%, we like to look at accounts as well and say, hey, should we do a Roth conversion now? Because then we're paying taxes on an asset that has lost value recently. And then when things recover and markets get back to normal, now we've converted it, paid tax, potentially on a smaller amount, and then the growth of the recovery would then be tax-free. So many of you are on kind of our Roth conversion list. It's something you want to dig deeper into. We can definitely run a calculator and help you kind of understand the long-term benefits of that. Okay, so we kind of went through some of the basics of just retirement accounts. The other part we want to discuss is how long-term capital gains are taxed and qualified dividends. And so long-term capital gains are assets that are held for longer than 1 year. If you sell them, once you've held them for longer than a year, then they go into this long-term capital gain bucket and you pay tax at a different rate. If you hold it less than a year, then that actually becomes, or it's considered a short-term capital gain, that is taxed at ordinary income. So whatever bracket you're in, that's what you're taxed at. And then qualified dividends, that's mostly dividends that are coming from stocks. So most of what comes out are qualified, not all, but most. So again, they get preferred tax treatments, right? So you can see the married filing jointly. There's a 0% tax rate up to $83,000 of taxable income. Between 83 and 517, the tax rate's 15%. And then you have a tax rate of 20% above 517,000. So you can see long-term capital gains are quite favorable relative to the income, but nonetheless, you obviously can see kind of that breakout. The other thing that you got to look here is on this the plus line. So right under this bracket, it says, or under this box, it says plus 3.8% net investment income tax. So we referred back to some of the ACA costs, and so that does apply on top of this. And so technically, if you're in the highest bracket, that your federal income tax on long-term capital gains would be 23.8 when you add that. So again, it's a pretty decent jump, that additional tax that you have on there. All right, so that's some of the basics. Now I want to run into just some of the things we actually do behind the scenes as your wealth management firm, and some of the things that we think are really critical. So I'll walk through kind of a case study. It's getting a little bit technical, but I think this will make sense. Now, mind you, the last couple of years, markets have done really well. We had a decent amount of capital gains at the end of last year that clients had to pay tax on, and we didn't have last year. The markets were hardly volatile at all, so we pretty much just had gains all of last year. So there wasn't really any opportunities to do what's called loss harvesting. So we are doing that today because we've seen volatility appear in the markets, and we've seen some weakness. And so we're utilizing this, going into accounts and saying, okay, what can I sell for a loss so that I can have this as a future tax asset, meaning it's something I can use to offset future gains. So that's what we look at when we're doing what's known as tax loss harvesting. So this only applies for your taxable accounts, right? Because IRAs, Roth IRAs, things like that, those are all tax sheltered anyway, unless you take money out. So we're just talking about your taxable accounts. And so when we get into tax loss harvesting, let's talk about what this is. So I'm just going to use a hypothetical. This applies to any real value, but let's say you have a taxable investment account of $5 million, and it's designed to be for your retirement living expenses. And so we set up an allocation for you that had about 60% in stocks and growth investments and about 40% in fixed. So we kind of broke these into two different buckets, and we say, okay, our stock investments, which are about 3 million, those are long-term focused, right? Those are the assets that are going to grow over time, that are designed to keep pace with inflation. So that's what we have in this bucket. And on the other side, we have the fixed income investments, right? Bonds, cash, things like that, which are shorter term focus, which is designed to provide liquidity, provide income. And so the goal here is we take a total return approach, and we're going to withdraw $200,000. That's what you need to actually live off of, right? So that's that plus Social Security, things like that. So that's how we look at this bucket, right? So we allocate the money accordingly into this mix. Now, if we just took a buy and hold strategy, which is what most investors tend to do, and we look at a scenario, so we have basically kind of three bar charts here. We have the initial investment, and so we're just going to look at the stock component of this. So we have the initial investment in blue, that's the value, $3 million. Now we go through a market decline. Market declines 20%. So now that $3 million is no longer worth $3 million, it's worth $2.4 million. And $2.4 million means there's a loss of $600,000. So now the market recovers. At the end of the year, the market was up 10%. So it's now back to 3.3 million, which now means you have an unrealized gain of 300,000. So, and walking through this scenario, when you had the market correction, we had an unrealized loss of 600. And by the end, we had an unrealized gain of 300,000. Now, by doing this, and you need 200,000 to live off of, you'd have to go into the portfolio and sell something, right? So let's presume we're going to sell your stocks. We're going to take some profit. You're going to realize about 20,000 in capital gains, and that at a 30% tax liability between federal and state, you're going to owe about $6,000 in tax. Right? Not terrible in tax, but nonetheless, it's still an amount that you'd have to pay. So this is just the buy and hold, right? This is just kind of set it and forget it. And this is where we're unique. This is what Vance Wealth employs for you, because it's the right way to do this. And so we added another bar chart here. So what we do is we have the original investment, 3 million. We had the same 20% decline of 600,000, but then we trade the account. We do what's called loss harvesting, and I'm going to explain what that means. So we realize $600,000 of loss. We reinvest into similar investments, and I'll discuss kind of what some of the protocols are for that. And then when the markets recover, now we have a realized loss of 600,000, and we have an unrealized gain of 900,000. So, and it's unrealized, which means you don't have to pay tax on it until you sell. Well, you're still the investor. You need to live off your 200,000. So you come in, you take $200,000 out. Now, because of the recovery, you actually have 54,000 in realized capital gains in order to, kind of fill your cash bucket to spend for the year. But you have no tax liability. Instead of that, instead you have basically your tax loss carry forward is now worth $545,455. So that's what you have. So basically how this works is when you do loss harvesting appropriately and you book these losses, and then you get the recovery, and then you need to spend money to live off of, then you get this big loss that you can start using all future capital gains against until you use it up. And if you don't have any gains in the year, you see the note in the very bottom right corner, you can take a $3,000 tax deduction on your 1040. So if you don't have any gains, so if you have the next year you had 100,000 of gains, you can offset that. And the next year you have 100,000, you basically can use it until you use up all of the loss carry forward. So really important to know. We're going through that right now. Actually, I think we're making trades today, or they're going to go tomorrow, because there's been a lot of volatility in the bond market. And we'll talk more about that at a later webinar. That's probably going to be a June topic, just to kind of give you a heads up on that. So that's a simple idea around loss harvesting. So, we sometimes will get questions like, how does this work? Like, okay, so I have a couple scenarios here. This is the kind of the bottom half here, asset sold for a loss. So you have a mutual fund or an ETF from company A, and you go to a different fund from company A. So it's a different fund. There's something called a wash sale. So this is what's really important with tax loss harvesting. If you're going to sell something for a loss, you cannot repurchase that same investment for 30 days. So technically you need to sell it and you need to get out of the position. And if you want to repurchase it because you like the investment, you need to do it basically in the 31st day. So that's to avoid a wash sale, because if you don't avoid the wash sale and you break that rule, then technically your tax loss is disallowed. So this is just a couple scenarios on, okay, if you mutual fund from A to a different fund, there is no wash sale, so you're good. A large growth fund to a different large growth fund with different holdings, no wash sale. An S&P 500 ETF with a different S&P fund ETF. The rule is probably, so technically if it's substantially identical, then it probably could violate the wash sale. So we do what we can to try to mitigate that. And then you can look at the bottom ones, which are all definitely a wash sale. So if you have, basically, if you buy something, and you can see kind of the notes here, individual taxable account, you bought the same position in the spouse's account, or you sell it in your trust and then you bought it the same position in your IRA, that would violate wash sale rules. And so it's important to kind of to really understand that. And I believe our custodian, Raymond James, will actually report that any wash sale violations on your tax forms for you. So again, we try to do our best to mitigate that, because we obviously don't want to have a wash sale rule in place. And then you can see here some of the strategies. So you can just sell the asset and then repurchase it after 30 days. You can double up on a position. So this doesn't work for big positions, but you can just double up. You say, I own 100,000 of this. I want to buy another 100,000. And then after 30 days, then you basically resell the original position. So those are definitely some strategies that we can look at. So we help you employ all this, but you just want to make sure you're avoiding the wash sale rules, because otherwise you're basically the whole purpose of the tax loss harvesting did not come to fruition because you did not accomplish your goal. Okay, so another thing, so we're going to move from that. So that was a little bit of just a background on tax loss harvesting. This now will go into this idea of asset location. So where do we own certain assets? When we're building portfolios, we recognize clients have taxable accounts, IRA accounts, Roth IRA accounts. Generally we want to have more growth focused investments in our Roth because we're getting compounded tax-free growth for life. So we like those. And then when we're owning other assets and trying to kind of figure out how to split them, we do recognize that some assets are better held in taxable accounts and some assets are better held in tax advantage, like IRAs. And so you can see on taxable accounts, passively managed investments, more like ETFs, they tend to be a better fit. And you've probably gotten some notice from us on us switching some of our strategies to more ETFs to really capitalize on more efficient investing. Qualified dividend positions, those that are paying out qualified dividends, stuff that's long-term we have long-term holdings, right? Because if you buy something, you don't sell it and it goes up in value, you don't pay tax until you sell. So anything that's going to be a long-term holding, tax exempt bonds. So that's municipal bonds primarily. So that's what you want to own, like in your taxable accounts. And then on the far right, then you can look at tax advantage accounts, actively managed investments. And that's what we do. Short-term holdings, taxable bond funds. So bonds that are actually paying, you have to pay tax on the income. So that's what we own in the tax advantage account. And then situational, things like, we haven't really got into like precious metals, cryptocurrency, but like REITs, real estate investment trusts, kind of situational. So we'll own them on both sides, but they're a little bit more efficient to own it on the tax advantaged side. So asset location is a big part. We talk about asset allocation is how do you divvy it up, how you divvy up your pie chart, but also asset location. What are the best types of assets to own in certain accounts to help minimize your overall tax liability? So many of you also are, love the idea of kind of building that legacy for your children, and by helping them with either funding college, paying for college, funding some investment accounts like custodian accounts, even, if they're working, even doing some part-time work when they're in their teenage years or in college, is helping them fund like Roth IRAs. We love all those planning ideas because it does really set up that next generation for success. One of the things to be aware of is that if you set up a taxable account, like a bank account that's in the name of your child, like a savings account, I know they don't earn much interest, but basically there's a kiddie tax that's in place. And so it applies to children under 19 or full-time students under 24. And it's taxed at the parent's tax rate with unearned income. So unearned mean investment income over $2,300. So unearned income, investment income, Social Security, retirement plan distributions, right? So that's what gets factored into this kiddie tax rule. And basically what it does is it prevents parents from avoiding taxes by shifting assets to children. So if you are going to be giving money to your children, especially if they're going to be going to college, 529 plans are quite powerful, especially like front loading it, because when you put the money in there and it compounds, you can see the note at the very bottom. If you put in $80,000 and it grows at 7%, after 17 years, it'll be worth $252,000 with that hypothetical, which basically means all of that growth, that $170,000 or so, will be tax-free if used for school. So really powerful. The Roth IRAs as well. They have to have earned income. So if they're not working, they need to have W-2 wages, but I'll just look at the note at the bottom. It says, if you fund 6 years, or if your child funds 6 years, 6,000 per year, if they get 8% growth on this and it's in there for 40 years, that $6,000 per year contribution will add up to 1.6 million 40 years out. So pretty powerful. There are some rules around getting access to that money early for like a first-time home purchase. So just be aware of those if you're going to be kind of from a estate planning perspective, or you want to help even grandchildren. Just be aware of some of the rules around this kiddie tax, because you don't want to get caught up in that, because you just pay at a much higher rate and it's avoidable. Okay, next component. Many of you, we spend a lot of time on how do we maximize your charitable giving. There's a really cool chart to see here, because look at the total charitable giving in the US in billions, and it's almost $500 billion. That's the total. So we are clearly the most generous nation. We're the wealthiest nation, but we're clearly the most generous. So it's really nice to see that that's been growing over the years. And we got to also be realistic that while people give to charity because they want to help the local charity out, or whatever charity that is important to them, but there are tax benefits of it. So we're going to talk in this section on how do you maximize your charitable giving strategies in a way that obviously reduces your income tax this year and in future years. And remember, charitable giving, when you make that gift, the benefit is you do get a tax deduction as long as you're itemizing your deductions. But it's got to be because you care about the charity. The tax deduction is not big enough to incentivize giving to a charity that you're not passionate about. Okay, so a couple of just quick things, a lot of data on here. We're big proponents of having you give appreciated investments. So like an appreciated stock position, an appreciated mutual fund position, an appreciated ETF. So that is our preference. And so on this list here, it's the third item down, and it's long-term capital gain property. So anything that you've owned for longer than a year, that is our preference over cash. So cash is our second preference. So we first want to we want to donate directly to the charity, or donate directly to like a donor advised fund. And then basically the note here is you can see on here is what deduction do you get, and the FMV stands for fair market value. So if you buy a stock for $10 and when you give it away, it's worth 100, when you donate it, as long as it's long-term capital gains, you get to donate the fair market value of the stock at $100. And so depending on how many shares you give, that'll give you the size of the deduction that you get. And then the note on there next to the fair market value, or the FMV, is 30%. So that means you can deduct the charitable gift up to 30% of your adjusted gross income. So You can't give away more than you earn and not pay any taxes. So there are some limits. When you give cash, the limit's higher. It's up to 60%. I think right now there's like a bonus where you can give up to 100. You get 100% deduction, but that's temporary. So these are kind of more the permanent rules. This is giving, again, to a public charity. If you have a private foundation, you still can make the gifts, but they're limited on the amounts. So the important thing to know is the gifts have to be completed by year end. So these are gifts that have to happen. You can't use the tax deadline of April 15th. So your charitable giving strategies should be starting now. And that's definitely something, if you haven't had a conversation with us, we do need to dig into that. Because there's a lot more effective way to be giving in terms of giving appreciated securities versus cash. So those are the deduction limits. There's also something that's called bunching your giving, which means you're trying to give. If you're on the cusp of either you are itemizing or you're either barely itemizing your deductions, or you're now taking the standard deduction and you are still charitably inclined, you might want to consider bunching your deductions. So what we're basically looking at on here, there's a lot of data. The top part of this, it says under the blue banner, basically that you give a $8,000 per year charitable gift, and then it shows you what the actual deduction is. And then if you look under the green scenario, this shows that you give the same amount, but instead of giving the $8,000 per year, you're giving $16,000 every other year. So it's the same charitable gift. And by doing so, it gives you an additional $12,000 of additional deductions above the standard. So it's something that can be powerful to be utilizing and to actually bunch your donations. Or if you know you're going to have a big one-time event because you sold an asset, then you can do an even larger gift to like a donor advised fund. So basically, what a donor advised fund is a charity that you as the donor set up, and you put money into their ideally appreciated securities. You put money into this account and you get a deduction at the time you make the contribution. So when you put the money into the account, you get the deduction right then and there. So if you want to make a donation of $100,000 because you needed to save taxes, you can put all that money in. And the beauty of a donor advised fund is when you give it to charities is on your time frame. So what that means is that if you put 100 in, you get the deduction today, but you might decide, you know what, I only want to give out 10,000 a year to this charity. So then what happens is you have this investment account with 100,000. It's no longer your money because you made the gift, but you can use that to facilitate ongoing giving. We love these types of accounts, especially for those of you who have, who are passionate about charities, and that's going to be part of their long-term plan. There's a lot more notes here, but the great thing is when you donate the appreciated securities, you don't have to pay tax on selling an asset. So these are really powerful ways to reduce your taxes, again, especially if you're charitably inclined. The other thing that is also available to you if you're charitably inclined and you're over 70 and a half is that you can donate directly from your IRA. So this is really important. So a donation directly from your IRA to a 501c3 nonprofit. You can't give from your IRA to a donor advised fund, a charitable remainder trust, private foundations, those are not allowed. This is for individuals over age 70 and a half with traditional or inherited IRAs. And one of the things is we know that the RMD age moved back to 72. The QCD, or the qualified charitable donation, is still available at 70 and a half. So you can utilize this. This will satisfy all or part of the RMD. So if you are having to take a required minimum distribution and you don't need it because you have enough other income sources, you want to give to charity, you basically can just give directly through a qualified charitable distribution directly to the charity, and it will satisfy your RMD. So that's a really powerful way to keep your income down. We do this a lot when we're trying to reduce people's modified adjusted gross income for Medicare planning, because once you're on Medicare, the more income you make, the higher Medicare premiums that you'll pay. So as clients are starting to have to take money out of their IRA, we can use a QCD as a really terrific way to reduce your taxable income, especially when considering the calculation for Medicare premium surcharges. So QCDs are great. And again, these are topics that I know you've heard me talk about before, but this is really our tax planning 101. It's just a good refresher on things to consider. The one thing that I would encourage you, if any of you are giving to, like, let's say a church where you're participating in and you're giving, you have a habit of giving, weekly or monthly, either with a check or cash. And sometimes this is a little harder to do, right? Because you want to be giving more frequently, not just one time. You can set up gifts from like your donor advised fund to just go out of your account every, weekly would be too much, but you can have it set up on automatic, giving to go out like $1,000 every month. And so donor advised funds, even from your IRA, giving, we can give on a more regular basis, like quarterly, if annually just doesn't work. So great planning tool to make you aware of. Another one that we get a fair amount of questions about, and this is another way to save some taxes, is by contributing to a health savings account. So health savings accounts are pretty powerful. You get a tax deductible contribution. Your money will stay in the account and it'll have tax deferred growth. You actually can invest the money, tax deferred growth. And then when you take it out for medical expenses, you have tax-free withdrawals. So this is essentially the only type of account where you get a deduction going in and it comes out tax-free. So really powerful. So the maximum family contribution for 2022 is $7,300, an additional $1,000 catch-up. You must have a high deductible health coverage. So, and you can't contribute if you're enrolled in Medicare. So that's important to know. So these are great for kind of what I would say younger, right? If you're in your 30s, 40s, 50s. And the nice thing with the health savings account is you do get the deduction. You're going to pay a little bit more out of pocket for some of your medical, but then you can do so with you basically will have an HSA account that will be cash that you can utilize to cover kind of current medical expenses. And so just be aware of that. If you haven't looked into health savings account, most even group plans have these as options. They're really pretty powerful vehicles, and you can just see some of my notes on there. Let me see. It looks like we got a question. Can you put money in an HSA if you have a regular PPO plan? So yeah, if you have a PPO, you can contribute to an HSA. When you say regular, I'm assuming by regular you mean it's not a high deductible, then the answer is no. So it has to be a high deductible plan, or high deductible has to be basically HSA eligible. A lot of PPOs are set up that way, but if you have one that is not HSA eligible, then you will not be allowed. But you can usually switch, right? So if you're in a group plan, they usually will offer more options. Yeah, so if you're in a low deductible plan, that will not work. Okay, good question. Thanks, Nadine. All right, so then I think ad nauseum I was covering all the proposed tax changes from last year. I think we did several webinars on what some of the Biden administration tax proposals will be. So I'm not going through a whole laundry list, but there was some of the key tax proposals which are still on the table. I have no idea if anything's going to get passed this year. This was part of this Build Back Better agenda, which was from November of last year. So this is kind of what got settled on. Potential surcharge on additional 5% income if you earn more than 10 million, and an additional 3% if you make more than 25, right? So this is a really small group of income earners. Whoops. And they were looking at extending the child tax credit. They were looking at limiting IRA contributions. So once your balance got above $10 million, that you would actually not be able to add more money to your IRAs, and you'd have to start taking a required minimum distributions to keep you below that threshold. They talked about raising the SALT cap, which I know would be a big relief for a lot of California taxpayers, a lot of our clients. They were talking about raising the cap from 10,000 up to 80,000. Again, that would have been pretty powerful. But this did not get put in place. So if you look at the very bottom, drop from the previous proposal was this 39.6 top individual rate, 25% tax on long-term capital gains. So just some different things, and you can kind of see that. So I don't know if there's going to be any political capital right now to actually get a tax proposal in place before the midterms. It'll be interesting. It's kind of quieted down. So I don't really have more information. I do know that we'll likely do a year-end tax planning. I'll have a little bit more business. So if any of you are business owners, a lot of this was how it impacts your personal return. I'm happy to chat one-on-one on more business related items. But we'll likely do a year-end one that's going to that will have a little bit more business, a little bit more year-end planning that we can take advantage of. So as just a kind of quick reminder, anybody's on this call would like to just have a complimentary consultation with our firm, go ahead and click this or scan this QR code, or just log on to our site and you can see the URL there to book an appointment. Also, just want to remind you a couple things. So we're actually going to have 2 webinars in May. They're both going to be legacy focused. So we're going to do a legacy webinar. Patty Handy, one of our advisors, is going to be hosting that, and we'll be getting some information out on what we're going to cover there. And then I'm going to be doing my normal Advanced Perspective monthly webinar. I have a estate planning attorney that's going to be a guest, so it'll be able to give you kind of an update on estate planning items. So that's going to be a great topic. And then if you didn't see any of our press releases, just special announcement, we actually hit starting this year 500 million in assets under management. So we're really excited. That's a pretty important feat for our firm, and it's really a testament to all our clients and their commitment and continuing to work with us, and the partnership that we're obviously have built with many of our families and households that we've been serving for almost 20 years. So just want to thank you all for obviously your commitment to us, and just thank you. So that wraps up our tax workshop. I got you under the hour, which I always like to do. I don't see any more Q&A. So again, thank you all for attending. Hopefully this was some valuable information. If you have any more direct questions, feel free to reach out to me via email, and have a great night. Thank you.